India's economy is either on the brink of collapse or on the verge of becoming a superpower. And depending on who you follow, both seem equally convincing. So today, we ignore the noise and look only at the numbers. India is not in crisis, but it may be doing something far more damaging than crisis. Quietly, slowly, in a way that won't show up on any headline, but will show up in your salary, your savings, and your investments over the next decade. I spent weeks going through the actual numbers: GDP, jobs, household debt, foreign investment, and what AI is doing to the one sector that was keeping India's middle class afloat. And what I found changed how I think about this country's future. Most financial content on India gives you only one or two things: blind optimism or unnecessary panic. This video gives you neither, just the data, the context, and the honest picture, including the parts that are genuinely working and the parts that should genuinely worry you. If you have ever felt like India's growth story wasn't quite adding up for you personally, this video is exactly why. And I want to walk you through exactly what I found. By the way, I'm Nikhil. I'm a chartered accountant by profession with nearly 2 decades of experience with EY, PwC, and one of India's top wealth management firm before launching my own startup. This is Finicky, where I simplify money the same way I practice it. Now, let's get into it. In 24-25, India's real GDP grew at about 6.5%. In nominal terms, before adjusting for inflation, that's close to 10%. We are now the world's fourth largest economy at roughly $4.2 trillion, having overtaken Japan. Though Germany still sits ahead of us in the queue, and the trajectory looks even more far impressive. By 2030, projections place India at around $7.3 trillion, more than double of today's size, built on 3 decades of steady growth averaging around 6%. Very few large economies have managed that kind of consistency, but here's a question I want you to sit with. Is that speed actually enough? The goal is Viksit Bharat, a fully developed India by 2047. Most economists agree that to get there, we need a growth of 8% or more every single year. 6.5% growth is very impressive, it's strong, but it's not just strong enough for that ambition. So yes, when you hear India called the fastest growing major economy, that part is true. But whether it's fast enough is a completely different question, and it's in the gap between those two ideas that this entire story lives. Because once you look past headline numbers, you start noticing the cracks, and some of them go much deeper than they first appear. First crack is the job gap. Every single month, roughly 1 million young Indians enter the workforce. 1 million people looking for a job every month. And the economy is simply not creating jobs enough to absorb them. A big reason is the structure of our growth. India's service sector, IT, finance, software, accounts for over 50% of the GDP. That sounds impressive, and it is. But services don't create mass employment the way manufacturing does. A software company can generate enormous revenue with a relatively small team. A factory making shoes or steel employs hundreds or thousands of employees. When you're trying to employ a country of 1.4 billion people, that difference is everything. Some point to the gig economy as the answer. It may employ around 23 million people by 2030, but when your work age population is close to a billion, that's barely a dent. And this frustration showed up directly in the 2024 elections. Despite strong headline growth, analysts kept pointing to the same reason for underperformance. People saw the boom on paper, but they didn't feel it at home. Crack number 2, foreign investment is quietly pulling back investments. Now, here's a crack that rarely makes the front page. Back in 2008, foreign direct investment accounted for 3.6% of India's GDP. By 2023, that number has fallen to just 0.8%, and 23-24 gross FDI stood at around $71 billion, the lowest in last 5 years. But the more recent story is even more sharper. Even as gross FDI recovered slightly over $80 billion, net FDI, the money that actually stayed and worked in India after accounting for exits, repatriation, and outward investment, fell to nearly zero in 24-25. Think about what that actually means. Money is coming in, but almost the same amount is walking right back out. That's not just caution, that's capital barely choosing to stay. And it just tells us something important. Despite a strong domestic growth story, global investors are still cautious. Structural issues, policy uncertainty, and fierce competition for capital continue to influence where long-term money actually goes. Crack number 3, the AI threat nobody's talking about. And then there's a crack that didn't exist 18 months ago, one that strikes at the very heart of India's service economy. In February 2026 alone, India's IT sector lost over 6.4 lakh crore, roughly 68 billion in market capitalization. The Nifty IT index fell 21% in a single month, its worst performance since the 2008 financial crisis. Not because earnings collapsed, but because investors started asking a question they had been quietly avoiding. What happens to Indian IT when AI can write, test and modernize code at the cost of electricity? Now, here's why this matters far beyond the stock market. India's IT sector employs close to 5.8 million people. It contributes about 7.5% of GDP and it accounts for nearly 45% of India's total export earnings. It is the single largest engine of formal, high-paying urban employment this country has. It also is a key pillar of rupee stability. If AI erodes even 20 to 30% of billable project hours, and early evidence actually suggests it already does, the ripple effect hits middle class incomes, urban consumption, and foreign exchange buffer we just called a strength. Nobody knows exactly how this plays out. Some analysts believe Indian IT firms will adapt, selling AI transformation instead of headcount arbitrage. Others say the entire labor cost model that was India's core advantage for last 30 years is simply becoming obsolete. But what we know is this: the one sector reliably creating high-paying formal jobs is now facing disruption from AI at exactly the moment India can least afford it. Crack number 4, the stock market. By mid-2025, fears around global tariffs and weak sentiment started weighing on Indian markets more broadly. The Nifty 50 and Sensex fell for 5 consecutive weeks, one of the longest losing streaks investors had seen in years. Foreign investors started pulling money out, chasing safer returns in stronger US dollar. Company earnings kept disappointing, and that big middle-class spending boom everyone was counting on, it simply didn't show up. In 23-24, private consumption growth fell to roughly 4 to 5%, its weakest in 2 decades outside of COVID, even as GDP grew much faster. Urban household especially felt that squeeze. FMCG volume softened, vehicle sales stalled, companies kept reporting weak demand numbers quarter after quarter. The chain reaction is simple: when people spend less, businesses earn less, profits fall, and eventually the stock market reflects the stress that ordinary families are already living with. Crack number 5, disappearing savings. This one is talked about the least, but it might be the most important one. For years before the pandemic, Indian households consistently saved about 7% of GDP in net financial assets. That savings pool is what funds bank loans, business expansion, and long-term investments. It's the quiet engine behind growth. That engine is losing power. Net household financial savings collapsed to just 5.1% of GDP in financial year 22-23, the lowest in half a century. Meanwhile, household debt has climbed to roughly 40 to 42% of GDP. Think of it this way: if your household used to reliably save a meaningful chunk every year and now you're borrowing just to pay for groceries and school fees, that's not growth, that's stress dressed up as spending. And if this continues, India will have to rely more on foreign capital to fund its growth. Foreign money can be helpful, but it's also fickle. It flows in when everything looks perfect and leaves the moment sentiment turns. An economy built on shrinking domestic savings and volatile foreign capital becomes far more fragile than the headlines suggest. Let's be direct. Some of these cracks weren't caused by bad luck, they were self-inflicted, and they started long before COVID. Picture this: November 2016, a small textile shop owner in Surat, he wakes up, opens his shop, and by evening, 86% of the cash in the entire country has been declared invalid. His supplier won't accept the old notes, his daily wage workers can't be paid, his customers have no cash to spend. He doesn't close for a day, he closes for weeks. That was demonetization and multiplied across millions of small businesses. That's what it did to the economy. Most economists agree it caused serious short-term damage. The long-term gains are still being debated. Then came GST in 2017, a necessary reform but rolled out too fast. Small businesses already bruised by demonetization were suddenly navigating new filings, new rules, and new compliance requirements. Cash flow froze, many never fully recovered, and then COVID in 2020. A lockdown announced with just 4 hours' notice. Migrant workers walked hundreds of kilometers back to their villages carrying everything they owned. Supply chains collapsed, GDP contracted by 7%. India recovered, yes, but the recovery doesn't mean everything healed. Those are the cracks, and some of them go deeper than most people realize. If you're finding this useful, hit the like button and subscribe. It genuinely helps more people find this kind of content. Now, because this isn't a one-sided story, let's look at what actually is working. Because some of it is working really well, and understanding both sides is the only way to get an honest picture. Before this sounds entirely grim, let me stop for a moment. Because this is not a story of a collapsing economy. Several things are working quite well, and I'm actually speaking very, very well. And ignoring that would give you a distorted picture. Inflation is genuinely under control. In September 2025, it has hit 8-year low of 1.54%, which is comfortably within the RBI's target zone. For a country that had spent decades battling unpredictable food prices, that's meaningful breathing room. India's external balance sheet looks solid. The current account posted a surplus of 13.5 billion in the last quarter of 24-25. External debt stands at around 747 billion, but as a share of GDP, it's actually declined slightly to 18.9%. No currency free fall, no emergency borrowing, no panic. India has buffers, reserves, and time. The digital economy is real and growing. UPI is now clearing around 20 billion transactions every single month, accounting for over 84% of India's retail digital payment volume, and processed 260 lakh crores worth of transactions in financial year 24-25 alone. India's total service exports are approaching 400 billion a year, with roughly 260 to 270 billion of that coming from digitally delivered services, making India the world's fourth largest digital service exporter. Infrastructure spending is showing on the ground. Capital expenditure held at a historical high of 3.4% of GDP in 24-25. With Bharatmala and Sagarmala, travel times are falling, logistics are improving, and connectivity is visibly better than a decade ago. Tax collections are stronger and more consistent, a sign that more businesses and incomes are entering the formal economy. And the banking system is far healthier than it was 10 years ago, with bad loans significantly lower and balance sheets cleaner. None of this erases the cracks. The problem don't vanish because some things are going right. But it does explain why this isn't a simple rise or a clear fall. It's messier than that. And understanding that complexity is the only honest way to assess where India actually stands. India is not Sri Lanka in 2022, running out of foreign exchange, struggling to import fuel. It's not Argentina, stuck in a currency spiral with triple-digit inflation. And it's certainly not Pakistan, where external debt is close to 40% of GDP and the currency has lost most of its value. India has stable institutions, a massive domestic market, and real financial buffers. Those things matter more than we sometimes give them credit for. But here's the honest part. What India does have is a slowdown exactly where growth is needed most. Manufacturing is not firing the way it should. Jobs are not being created fast enough. Household savings are shrinking. Foreign investment is barely staying, and now the one sector that was reliably producing high-paying jobs faces an AI-driven reckoning. This doesn't look like a crisis, it does look like a friction. Economists call it the middle-class trap. It's what slowed Brazil, South Africa, and several Southeast Asian economies. India isn't stuck there yet, but the window to escape isn't unlimited. Right now, India has the largest young workforce on earth. This demographic dividend is our single greatest economic weapon. But by 2040, this window starts to close. India's population will begin to age. The tailwind becomes a headwind. Every year that passes without creating enough jobs, without scaling manufacturing, without pulling people out of subsistence, is a year that cannot be recovered. And here's the dimension of this story that rarely gets discussed openly. India now has more billionaires than Germany, France, and Japan combined. Meanwhile, real wage growth for that median Indian worker has barely kept up with inflation for the better part of the decade. That isn't just optics problem, it is an economic one. An economy where most of the gains flow upwards cannot sustain broad-based consumption growth. And without consumption growth, the 8% GDP target becomes even harder to reach. Look at what China did with its window. In 1990, India and China had roughly similar per capita incomes. China chose manufacturing. It built infrastructure at a scale that world had never seen, made hard decisions that hurt in the short term. Today, China's per capita income is 5 times higher than India's. The question is whether India will use its own window. Because if it doesn't, here's what happens. And this is the part that doesn't make headlines. India does not collapse. There is no dramatic crash. What happens instead is quiet and in many ways more tragic. Growth continues at 6%, maybe even 6.5%. The billionaires keep multiplying, the skylines keep rising, the GDP chart keep climbing, and the 800 million people at the bottom stay exactly where they are. Maybe they inch forward, but they never get to leap. That's not a crisis you can point to a Bloomberg terminal, but it is a crisis nonetheless. The real crisis in India isn't a collapsing economy, it's a squandered opportunity. And the most dangerous thing about a squandered opportunity is that you only realize it's gone when it's too late to get it back. So, the next time someone tells you India is in crisis, ask them what numbers are they looking at. And when someone says it's unstoppable, ask the same question again. The truth, as it almost always is, sits behind the panic and the propaganda. India is a 1.4 billion person experiment in democracy, development, and ambition. It is messy, it is complicated, and it is extraordinary. Drop your take in the comments. Crisis, correction, or comeback. Subscribe if you haven't and share this with someone who needs a clearer picture of what's actually happening. That's it from me. I'm Nikhil Varghese. Subscribe to learn how to make your finances less tricky with Finicky. Thank you for watching, and I'll see you in the next one.